the billion-dollar corporate finance game. In 2013, Apple had over $100 billion in cash, and yet they issued $17 billion in debt. That's right, Apple borrowed money when it had a mountain of cash. Why? Taxes, capital structure, shareholder pressure, and something deeper, principles of corporate finance. From Tesla risking everything on Model 3 to Amazon reinvesting profits year after year, to Warren Buffett sitting on cash, waiting for value. Behind each move is a playbook, and it's been written, literally, in the book we're diving into today. Principles of Corporate Finance by Brealey, Myers, and Allen. This video? It's your crash course in how companies make billion-dollar decisions and how you can use those same principles in your own business, investments, or career. Why this book matters. When people talk about the Bible of corporate finance, this is what they mean. Originally authored by Richard Brealey and Stuart Myers, and later joined by Franklin Allen, Principles of Corporate Finance has been required reading in MBA programs for decades. Harvard, Wharton, London Business School, you name it. But this isn't just an academic tome. It's a practical guide to how real businesses work. How CFOs decide between taking on debt or issuing equity. How investors evaluate risk and return. How boards decide whether to pay dividends or reinvest in growth. How capital budgeting helps companies avoid billion-dollar mistakes. By the end of this video, you'll walk away with a clearer understanding of 8 core principles from the book, backed by real-world examples and usable insights. Let's get started. Main concepts and chapter breakdown. There can get breakdown. 1. Time value of money. Money today is worth more than the same amount tomorrow. Why? Opportunity cost. It's the basis of all financial decisions, and it's why we discount future cash flows back to their present value. Case study: Tesla in early 2010s. When Tesla was raising capital to build the Model S and then Model 3, every dollar invested needed to deliver future returns that justified the upfront cost. Without understanding the time value of money, those capital raises could have destroyed value. Why it matters. Whether you're valuing a business, project, or stock, understanding discounting and present value is step 1. 2. Net present value and capital budgeting. So how do firms decide which projects to pursue? Enter net present value, NPV. It measures how much value a project creates after accounting for the cost of capital. Case study: Netflix and original content. Netflix shifted from licensing to producing its own content. Shows like Stranger Things or The Crown represented multi-million-dollar investments. Their teams used capital budgeting to forecast whether future subscriber growth and retention would generate more value than the cost. Why it matters. If the NPV is positive, do it. Negative? Walk away. It's that simple and that powerful. Answers that. Rule 3, risk and return. And the CAPM, all investments carry risk, but how much return should you demand for taking that risk? The capital asset pricing model, CAPM, answers that. It links an asset's expected return to its systematic risk, measured by beta. Case study: Robinhood investors versus Berkshire Hathaway. Retail investors often chase high volatility, high beta stocks hoping for quick gains. Buffett, on the other hand, favors low beta, fundamentally strong companies that outperform risk-adjusted. Why it matters. CAPM helps you evaluate whether an investment is worth the risk for individuals and companies alike. 4. Capital structure. Debt versus equity. Should a company fund growth with debt or equity? That's the capital structure question. The answer depends on cost, control, risk, and even taxes. Case study: Apple's 2013 bond issuance. Apple borrowed $17 billion to fund shareholder payouts, even though it had plenty of cash. Why? Borrowing was cheaper than repatriating overseas cash due to taxes. Plus, interest on debt is tax deductible. Why it matters. The right capital structure minimizes the cost of capital and maximizes firm value. Get it wrong, and you either dilute ownership or over-leverage and risk collapse. Tash 5. Cost of capital, WACC. Think of WACC, weighted average cost of capital, as your company's hurdle rate. It's the average return your investors, debt and equity, expect. Every project, investment, or acquisition needs to beat this rate to create value. Case study: Microsoft's acquisitions. Whether it's LinkedIn, GitHub, or Activision Blizzard, Microsoft has to ask, will this deal return more than our WACC? Why it matters. It's the baseline metric every smart CEO uses before signing a deal. 6. Dividend policy and payout decisions. Why do some companies pay dividends and others don't? Miller and Modigliani suggest dividends are irrelevant in perfect markets. But in reality, dividends signal confidence, attract certain investors, and reflect capital availability. Case study, Microsoft versus Amazon. Microsoft began regular dividends as it matured. Amazon still reinvests heavily, believing growth generates more value than payouts. Why it matters. Your payout policy reflects your company's growth phase, investor expectations, and strategic priorities. 7. Market efficiency. In an efficient market, all available information is already priced in. Eugene Fama's efficient market hypothesis, EMH, says beating the market consistently is unlikely. Case study, the 2008 crash and irrational behavior. Even efficient markets have bubbles, driven by human psychology. That's where behavioral finance meets classic theory. Why it matters. You can't outsmart the market unless you have better info or better insight. For most, passive investing is a smarter path. 8. Financial options and risk management. Options aren't just Wall Street toys, they're powerful tools for managing uncertainty. Real options let businesses delay, expand, or abandon projects based on how conditions evolve. Case study, pharmaceutical R&D. Drug companies make staged investments. Each phase is like an option. Invest more only if early data is promising. Why it matters. Understanding options helps you manage irreversible decisions in uncertain environments. Bonus concept. Agency problems. What happens when managers don't act in the owner's best interest? That's the agency problem. Managers might chase empire building, avoid risk, or overpay for acquisitions. Case study, WeWork's failed IPO. Adam Newman's behavior showcased what happens when governance fails and incentives misalign. Why it matters. Corporate governance, stock-based comp, and board oversight are all tools to align interests and protect shareholder value. Real-world application. So how do you apply all this? For investors, use CAPM and beta to evaluate risk. Look at capital structure and WACC when valuing stocks. Understand payout signals, dividends versus reinvestment. For business owners and entrepreneurs, use NPV to evaluate projects. Decide between debt or equity based on cost and control. Set smart dividend or reinvestment policies. For students and professionals, these are the concepts that drive strategic finance decisions. Learn to build models using discounted cash flow, DCF, WACC, and NPV tools. Tools to try out, Excel, Google Sheets, NPV templates, Yahoo Finance or Finbox for beta WACC, Morningstar for capital structure analysis, Squirry Youth Summary. Let's recap the core ideas from Principles of Corporate Finance. 1. Time is money, literally. 2. Use NPV to make smarter investments. 3. Balance risk and return using CAPM. 4. Structure your capital wisely, debt versus equity matters. 5. Always know your WACC. 6. Dividend signal strategy. 7. Markets are smart, but not perfect. 8. And options plus governance shape real-world outcomes. Corporate finance isn't just spreadsheets. It's the language of decision-making in business. Master it, and you'll understand how companies grow, fail, and thrive. If this gave you a clearer view into how real companies operate behind the scenes, like this video, share it with your fellow finance friends, subscribe for more deep dive book breakdowns, and drop a comment below. What topic or book should we cover next? Thanks for watching. See you in the next one.